Welcome to Java. Thank you kindly for joining me. It's March 10th, 2025, and it is also Monday. I hope everyone had a wonderful weekend. There are quite a few things going on between last week and this one, so I believe I'm going to have to go back to doing a one edition over the weekend again. Please leave in the comments if you would prefer and would be easier for you to see these, whether it is Saturday or Sunday, because there is just so much going on. I can't possibly cover this all, but I'll do my best. So, welcome in, grab a cup of coffee. We've got quite a bit to go over. The first thing I would like to start with is we've got our first real general artificial intelligence called MANUS. So, with this, it's kind of a conglomerate of multiple artificial intelligence specialties, and that is how it is kind of working a little bit faster and a little more efficient is using sub agents. We kind of spoke about this before, but they've got an official rollout. Now, with this, they got so many hits that they could not handle the volume. So I'll update you on this later. I do want to talk a little bit about what happened with the markets last week. Now, the United States dollar was extremely volatile. This was because of not just tariffs, but also some geopolitical things going on. We had China easing, doing quantitative easing, and we also had the rates with Germany unleashing their debt market. So, a lot of instability in these markets. We've got the Federal Reserve in the United States saying that they can afford to wait and see. So, not necessarily jumping into this easing policy of cutting. So, that all is weighing on markets. Had a lot of lower moves. We are in correction territory. No, nothing moves in a straight line, but it did not just a lot of chart damage, is what we call it under technical analysis of this dropping, but also psychological damage to investor sentiment. So, with all of this, what we're looking forward to this week is the CPI, more inflation numbers coming out on Wednesday, and we'll go over the calendar more in just a bit. Now, we've got fresh things moving on tariffs. This is also putting some pressures in, and United States 10-year yield against Germany's and Japan's. Now, as I said, a lot of volatility in the debt market, and these are major warning signals. Now, they came out with the GDP. We've also got massive moves in physical gold bullion, all of these serving as warnings. Now, finally, they're beginning to look at what I've been pointing out for a long time, is they need to look at the jobs market and layoffs, because we are clearly in a recession. They're just not calling it that yet. So, with all of this sell off, let's go into what is going on forward with this week. So, in the markets at this moment, we've got the MMRI has dropped. So, this is on all of these pullbacks saying that it's kind of deflated to a bit to where it should be setting levels. However, I am not confident on this at all, showing there could be further moves depending on what comes forward. Now, we've got the fear greed meter is finally hitting this extreme territory. It's at 19, below the 20 level currently. The 10-year yield with all of the volatility is still 4.249 at the moment, kind of rising with some of the others. We've got the dollar strength has dropped. It was as low as 102 last week. So coming back a little bit, but just losing its dominance definitely with these bond markets warnings. Now, Bitcoin and cryptocurrencies did take a hit after the summit. It's still above 81,000, right around the 82,000. If this drops further, could potentially go down to that 74,000 level for that gap fill that we've been speaking about. Now, along with this, the Japan 10-year yield, as I was saying, hit over a 16-year high. So they've got a close watch on their inflation, and it depends on what they're going to do with their currency. So that could be a repeat of last August hitting the United States markets. We've got futures showing there is more blood in store for the United States markets, and not a lot on the calendar to kind of turn this around. Now, The markets, as I've been saying, are headline driven. One piece of major data could reverse this, but it is not looking good. It would take quite a bit at the moment. So we've got America's job market, which is really, in my opinion, where they should be looking. And there's this particular one saying it's eerily similar to 1990s, prior to the dot-com bubble of 2000. And yes, it's a concern. I think they're wrong. I think it's much greater than the 1990s, and it's got more to go. So a lot of this blame is getting to a little bit more of the silly side, if you will, with mainstream media, saying that this is because Trump won't rule out a potential recession this year. Now, that's partially true because some of this is sentiment, and with the fear, however, it's him saying that there won't be a recession won't stop it. There are too many major factors going on. Now, with the calendar and earnings. First, we've got Congress again looking at the budget deadline to avoid government shutdown. Their whole move is to inflate. So they're going to approve this. It's almost not even news anymore because it's known that they're going to improve this, increase the ceiling, and increase government spending despite all of these Doge cuts and all of the news about Elon Musk and everything moving forward. So today, with calendar, we've got no major reports or economic things scheduled. Tomorrow morning will be job openings, so they will be kind of watching that after bad jobs reports at the last weekend, Friday. And then Wednesday, we're getting CPI, which will be the big thing that everyone is looking forward to as far as economic reports. Now, we've got a few earnings on the calendar, not anything that will really move markets. We've got also saying US economy is teetering on a recession, may be looming as the bond market reacts to the policies. They are behind, as always. The United States economy, real terms, is in a recession. We're going to watch this deepen and continue, but we're definitely in that recession territory. Again, they don't call it that until afterwards. And as I'm saying, the bond markets, we're watching those just absolutely blow up. Now, going to what's going on with a lot of these trade wars and what's going to push this forward. We've got a new person replacing Trudeau in Canada as Prime Minister, Mark Carney. He's a former central banker. So, head of the Liberal Party, saying that they're going to win with the tariff wars, and I've got news for him. I don't see that happening now. We've got, along with this, not just the United States, but China now, hitting United States with farm goods on their tariffs as they're escalating their trade wars, but not just the United States, also Canada. So hitting Canada with retaliatory tariffs on their agricultural goods. Now, the problem underlying this is that the Canadian consumer is already under massive pressure. They've got huge issues with their businesses shutting down, and they've got much larger deficits. They cannot handle enough of this. They cannot absorb what is going on and what China is throwing at them in tandem with the United States. So they will not last long. We'll see how this works out for them. It will have to stop one way or another. But the other Canadian politician that was up for this was calling for European nukes as protection from the United States. And I've got news for them there as well. As much as I love Canada, there wouldn't be enough nuclear protection either from the United States should it go to that escalation. Now, I would hope not. I hope that this all works out in a little bit of a different way, because a lot of this is also drama and a push simply for negotiation. And hope that we see that soon, prior to the Canadian people, who are always the ones to suffer for these silly political rivalries. And at the bottom of it, as always, is the central banks pushing all of these, and it is the people that suffer. So we've been talking about cryptocurrencies, and this is all a setup. It's all a setup from the banks from the bottom up. We've got Bank of America talking about another massive data breach. Now, this is all just posturing again, and I'm not saying that there wasn't a data breach. I'm absolutely certain that there was. However, in order to get people to accept the fact that they need to move to a different system for higher tracking, higher monitoring, and higher, in air quotes, safety, they're going to push moving towards using cryptocurrencies and using KYC, know your customer, more monitoring, and more control. Now, along with this, we've got one of the larger lending is always with housing because mortgages are the larger lending on the balance sheets. We've got the US Department of Housing Urban Development, better known as HUD. They are considering using crypto to pay the grants, the loans, instead of the US dollar. They're saying this could, blockchain tech would help them monitor the grants effectively and transparently. Now, this is grants. However, this will trickle down, so I don't, going to get comments about this. It's not the loans themselves, but it's only a question of time and also just a little bit of swapping out, if you will, is all it would take once they get this in uh, in motion. So, HUD using cryptocurrency going forward, they will be using stable coins. We also had this is from Besant, now the new one in charge, saying that US is going to put a lot of thought into the stable coin regime. And as President Trump has directed, we, meaning the United States, are going to keep the US dollar the dominant reserve currency in the world, and they will use stable coins to do that. So just want to leave you with that because they are setting up that reserve currency. They do have every intention possible to keep the United States in power through these fiat currencies, regardless of whether they are cryptocurrency or whether they are fiat printed or just printed on a screen. They handle all of these. So I'd like to move on from this. What does back all of this little bit of word is the military. And I just want to, again, I cannot stress enough how important this is going to become looking forward is the defense spending for multiple reasons. First off is capabilities. My apologies, this is calendar and it's not accurate, but could be a question of calendar moving forward because again, Anduril is the company and General Atomics. They are in charge of the drones. They're getting major contracts from United States military and they are doing uncrewed fighter jets, completely unmanned. This is the Fury, is one of them, the one in the background here. This is another prototype they've got coming out. Now, this down here is the naval warship that just came out completely unmanned called the Defiant. Now, these are multiple companies coming out making these. A lot of these also have contracts with Palantir. I've been warning about Palantir for a long time. So these are all positive for, of course, defense stocks. Palantir as a stock delivering mobile battle stations. Those are the trucks with the flip out for the field deployment that are portable office and recon missions, if you will. But what this does is this funnels money out again. Now, the good part is it's less loss of life on one side. However, there's a lot on the other to consider. So, with all of this, I've got to let you get to the trading day, and I will be in the Discord a little bit later on for any questions or anything there. But until I see you again, my friends, I wish you a wonderful trading day. And until I see you again, stay free.